Good morning, ma'am. Today we would like to present a little bit on the case 2, which is the capital structure, profitability, and market structure evidence from Malaysia. First, we will look into the introduction. Modigliani and Miller's academy contribution in 1985 and 1963 on capital structure, irrelevant, and the tax shelter advantages paved the way for the development of alternative theories series. And the trade-off theory, the pecking order and asymmetric information theory, and the agency theory are some of the alternative theories, as well as the empirical literature on corporate finance has recently focused on identifying some sterilite factors that determine capital structure. Therefore, the theoretical framework for the linkage between capital structure and market structure have been proposed by Brander and Lewis in 1986, Maximovic in 1988, Ravid in 1988, and Bolton and Scarfstein in 1990. Now we will move on to the problem statement. The problem statement, the problem arises in the article is the complex interaction in the market conditions, agency problems, and bankruptcy costs. The aim of this research is to discover a saucer-shaped relationship between capital structure and profitability as the results in interaction of agency costs, foreign costs, and debt shelter. A number of studies shows that the Q ratio and debt has a negative relationship, while others shows that they have a positive relationship. The relationship between capital structure and market structure is investigated empirically in this study because of the interaction between these two costs, which is agency costs, external financing costs, and the interest or tax shield. Study the structure and profitability. Next, we will move on to the review of the literature. The corporate finance assumes firms' objective is to maximize the wealth of shareholders, opposite to the theoretical framework that links capital structure and market structure when it is shown to the influence in the competitive conduct and plans of firms. In an oligopolistic market, to optimize profitability, which found by Brander and Lewis according to Brander and Lewis in 1986, said it is a favorable economic condition in their output. The output maximization hypothesis predicts a positive link between capital structure and market structure. This article also tells us about how the chances of financial distress and bankruptcy can increase the capital structures, as well as this shows the preview are not too broad and is still in context of the article. I will pass the next slide to my group mate.
Hi, madam. I'm Shubashini, and I'm going to explain about design and procedures for this article. This study is based on Kuala Lumpur Stock Exchange data of companies during the period of 1993 to 2000, where it excludes the financial and securities sector and companies with zero sales and negative equity. The data consists of 208 companies. Panel data is used in the estimation model. Panel data is where the data comprises observations where one company data at multiple time intervals. The assist in managing the effect of macroeconomic variables on capital structure. The study used uses a fixed effect model is a type of statistical model in which the levels or values in independent variable varies in response to the levels of independent variables. This model gives biased results if endogenous variables are included. In order to resolve the problem, the study estimates the uh, generalized method moment GMM, where it is in the charge of problem of endogeneity, the property of being influenced within a system by making use of instrument variables. Instrument variable is used to account for variable behavior that isn't predicted. So next I'll be explaining about the data analysis and presentation. The data of firms listed on the Kuala Lumpur Stock Exchange from 1993 to 2000. The study spans the years 1994 to 2000, with data from 1993 being utilized to calculate some variables in 1994. Basically, some of companies have missing their data. So in that, the data of those companies is adjusted with changes of their financial year. As a result of the change, 1 year's data is missing and the data of the following year is more than a year old. The data from the following year is first annualized, then the mean value is used to fill in the gaps. The findings. The data was quantitative data. The panel data, also known as longitudinal data or cross-sectional time series data in some special cases, in data that is derived from a usually small number of observations over time on a usually large number of cross-sectional units like individuals, households, firms, or governments. The result shows is to test the specification about the relationship between the capital structure and market structure or power Q ratio. As for the evidence is interpreted as consistent with the economic theory of output, maximization, and the finance theories of agency cost and bankruptcy cost. The evidence is supporting the hypothesis, which is negative relationship can be predicted between leverage and bankruptcy cost. For the purpose, the relationship due to the complex interactions of market condition, agency problems, and the bankruptcy cost, and the relationship between the capital structure and profitability due to the interplay and of agency costs of external financing and debt tax shield. The weaknesses and problems for this data analysis was the company should not take the risk of large projects since the company do not allow capital to run it. At last, the conclusion and implication for this article. The conclusion of this article is related with the original purpose, which is relationship due to the complex interaction of market conditions, agency problems, and bankruptcy costs, and the relationship between the capital structure and profitability due to the interplay of agency cost of external financing, and the debt tax shield. The implications for this article were discussed with, which is capital structure, market structure, and also the profitability from Malaysia. The results and conclusion of this study is affected Malaysian company who take the more borrowing to finance risky project. For my recommendation, the company should manage their finance by calculate the financial ratio to measure the company to repay the loan on time. And the company should not take a large amount of loan if they cannot pay it. Instead of they can rolling their model using their profit. It takes the less debt in the company. Thank you.